Hey everyone, welcome back to the channel. Today, we're diving into a super interesting topic: how to predict stock market movements using financial indicators. Whether you're a seasoned trader or just getting started, understanding these indicators can give you a major edge. So, let's get into it. Margin debt. First up, let's talk about margin debt. This is the amount of money investors borrow to buy stocks. Rising margin debt can signal bullish sentiment, as investors are borrowing more to invest. But be careful. If margin debt gets too high, it might indicate the market is over-leveraged, potentially leading to a sharp downturn if things start to go south. Interest rate. Next, we have interest rates. When interest rates go up, borrowing costs increase, which can cool off consumer spending and business investments, typically a bearish signal for the stock market. Conversely, when interest rates fall, borrowing becomes cheaper, often leading to a bullish market as spending and investments pick up. Yield curve. Now, let's look at the yield curve. This graph shows the relationship between interest rates and the maturity of debt securities. A normal yield curve, where long-term rates are higher than short-term rates, indicates economic growth and is generally bullish for stocks. But if the curve inverts, meaning short-term rates are higher than long-term rates, it's often a warning sign of an upcoming recession and a bearish market. Economic activity. Next, we have economic indicators. These are key to understanding the broader economic environment. For instance, a rising gross domestic product, GDP, suggests a growing economy, which can be bullish for stocks. On the other hand, if GDP is declining, it could be a sign of economic trouble, leading to a bearish market. Unemployment rate. The unemployment rate is another crucial indicator. Low unemployment rates often reflect a strong economy and can boost investor confidence, pushing stock prices up. But high unemployment might signal economic distress, which can be a red flag for the market. Consumer Confidence Index. And then there's the Consumer Confidence Index, CCI. When consumers feel optimistic about their financial situation in the economy, they're more likely to spend, which can drive up stock prices. Low consumer confidence, however, might lead to reduced spending and a bearish market outlook. Corporate earnings. Don't forget about corporate earnings. These reports give us insight into how well companies are performing. Rising earnings indicate strong business performance and often lead to higher stock prices, signaling a bullish trend. But if earnings are falling, it could mean trouble ahead and lower stock prices. Inflation and deflation trends. Inflation rates are also vital. Moderate inflation is typically a sign of a growing economy and can be good for stocks. However, high inflation can squeeze profit margins and erode purchasing power, often leading to a bearish market. And if we see deflation or falling prices, it usually signals economic trouble, which can be bad news for stocks. Volatility index. Now, let's dive into some market sentiment indicators. The volatility index, VIX, often called the fear gauge, measures market expectations of near-term volatility. A high VIX indicates high volatility and fear, often leading to a bearish market. A low VIX suggests complacency and a bullish market. Put-call ratio. Another sentiment indicator is the put-call ratio. This ratio compares the trading volume of put options to call options. A high put-call ratio indicates bearish sentiment, meaning more puts being bought, while a low ratio suggests bullish sentiment, meaning more calls being bought. Market breadth. Let's not forget market breadth. This measures the number of advancing stocks versus declining stocks. Strong market breadth, where more stocks are rising than falling, signals a bullish market. Weak breadth, with more stocks declining, suggests a bearish market. Moving averages. Now, onto technical indicators. The simple moving average, SMA, calculates the average stock price over a specific period, like 50 days or 200 days. It's a great way to smooth out price data and identify trends. When a short-term SMA, for example, 50-day, crosses above a long-term SMA, for example, 200-day, it creates a golden cross, indicating a potential upward trend. This is often seen as a strong buy signal. Conversely, when a short-term SMA crosses below a long-term SMA, it's called a Death cross, which signals a potential downward trend and a good time to sell. The exponential moving average is similar to the SMA but gives more weight to recent prices, making it quicker to react to price changes. This makes it more responsive and often more useful in volatile markets. Because the exponential moving average reacts faster to recent price movements, it's often preferred in markets that are more volatile, providing more timely buy and sell signals. RSI. The Relative Strength Index, RSI, is another powerful tool. It measures the speed and change of price movements. An RSI above 70 suggests a stock might be overbought, signaling a potential pullback. Conversely, an RSI below 30 indicates a stock might be oversold, suggesting a potential bounce. MACD. Then there's the MACD, Moving Average Convergence Divergence, a trend-following indicator showing the relationship between two moving averages. A bullish signal occurs when the MACD line crosses above the signal line, while a bearish signal happens when it crosses below. Sector performance. Sector performance can also give clues about market trends. When leading sectors like technology are outperforming, it can indicate a bullish market. Conversely, when defensive sectors like utilities are leading, it might signal a bearish market. Geopolitical events. Lastly, keep an eye on geopolitical and external factors. Events such as elections, wars, and global pandemics can create uncertainty or confidence in the markets. Significant geopolitical stability often correlates with bullish markets, while instability can lead to bearish conditions. Summary. By integrating these various indicators, you can better anticipate market movements and make more informed trading decisions. Remember, no single indicator can predict the market with certainty. It's all about using a combination to get a comprehensive view. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss an update. And let me know in the comments which indicators you use for your trading strategies. Until next time, happy investing.